All right, so our market economy, we took a kind of a deep dive into consumers with that utility business that we got into in Chapter 8. And so now we're going to spend really a large part, the next 4 chapters or so, multiple weeks, looking at businesses and looking at what their incentives and motivations are. And what I don't want you to lose sight of is there's issues beyond the money. And one of those issues, that's why I had this one up first, was the production process. So one of the things that businesses are doing, we tend to get kind of hung up on the making money part, which is a very important part of it. But there's also this physical production process that's going on where the basic resources of land, labor, capital, and entrepreneurship are being combined together into the outputs that give us happiness or utility, as we did for the consumers here. So we'll spend a little bit of time today looking at that production process a little bit more carefully, and then kind of show how that also connects into the money. Money. All right, so what is the goal of the business? What are they out to maximize? Profit. All right, so that's where we're going to start off here with producer theory, or firm. The theory of the firm is sometimes got different names for them. So businesses, firms, companies, corporations, small business, big business. We're kind of all lumping into this category. So we got Chapter 10 here. And we are skipping 9, that's right. Yeah, so Chapter 9 we did not do. That's another kind of deeper dive into utility theory, which I'd really love to do, but had to condense some of the material. So if you take intermediate microeconomics, we will take the deeper dive stuff into that and then some in Chapter 9. So this is Chapter 10, and then I also want to point out Chapter 10 is actually kind of a part of that chapter as well. So it's just the first section. It's on your syllabus, but basically section 10.1 that deals with profit. So it's kind of the first part of the section. If you're keeping up with the reading, the homework will kind of automatically is targeted in there. So, all right. So this is the theory of the firm. Is kind of what the section we're getting into. And as you just said, the firm's goal is to maximize profit. And we're going to learn some techniques on exactly how to do that. So maximize profit, profit maximization. So what is profit? And by the way, I'm using this notation of pi for profit. In macro class, that was inflation. But we don't really talk about inflation at all in micro class. So I don't know. I think that's what I used years ago, and that's just kind of stuck with it. So profit, if we put on our equation goggles, how do we calculate profit? We've done a little bit of this already in previous chapters. Profit. I like to think back to my, since I didn't hear anybody jumping, what'd you say, Ike?
I would say it's cost.
Okay, cost minus whatever you make, but I want to tighten that up a little bit. It does have something with cost and whatever you make. We want to tighten the screws on that. So my son used to make a lot of money as a 5-year-old. He wasn't a model or on TV or anything. But our house that we lived in up in Ames, Iowa, where Iowa State University is, was 8 houses from the football stadium. And so at age 5, he started doing a lemonade stand, which later grew into Rice Krispie bars and hot chocolate when it started getting cold out. But he would pretty much expect to make $100 a game as a 5-year-old. selling lemonade, because we'd have probably at least 10,000 people walking past our house. You put a cute little adorable kid out there at the card table with lemonade for sale, and you can turn some serious business. So, for my son Carter running his lemonade stand, how would we calculate his profit? Revenue and cost, right? So let's start with the revenue. So we've got total revenue is our first part of that equation. Total revenue, so TR. And how do we calculate Carter's total revenue from the lemonade stand? Total sales revenue. He was selling each one for, I'm laughing because it was usually, he did this one thing at one point. It was basically a buck of glass, but he said, Dad, if I do it for 75 cents, then they always leave me a quarter tip. So he would usually basically ultimately have $1. And since he was the sole proprietor of this little venture, he would get all the tips, and total revenue were really the same thing. So if each glass was $1, how much did he have in the proverbial cash register at the end? What's that?
The unit sold.
One time the unit sold, right? So it's price times quantity is our total revenue. Price times quantity sold, as you said. Price times quantity. P times Q. So if he sold 100 glasses of lemonade at $1 a piece, he made $100, right? All right, and then that, of course, wasn't pure profit because he has some expenses with the lemonade stand. What are some of those expenses? Lemon, sugar, cups, ice, the stand, the table. There was a little rental payment there from Dad, so that we got to take off the leasing. And then the land, there was a little rental contract for the little piece of land out in our front yard. So yeah, you've got leasing equipment, leasing of land. So all of those things are total cost of production, right? So we got price times quantity, total revenue minus total costs. TC. All right, and then, I usually don't do it this early, but it's possible to take all of your cost of production and look at the average cost per glass, right? So if we take all of Carter's expenses and all of that totaled up to be $20 worth of total cost, and if he sold 100 glasses, then this would represent the cost per glass, which would be how much? Who's got their math hat on this early? 0.2 of $1, 20 cents, right? So you'd have 20 cents per glass. So another way we could do that, TC divided by quantity, the average total cost. So kind of a neat little trick that we'll use in this chapter is to take the average total cost per unit times the quantity, just so we kind of have this even Steven. So, right, we've got the price per glass at $1, the average total cost at 20 cents, which means he was making about 80 cents. Anzi, you're disrupting class. Why don't you take off your mute?
I'm not about.
There we go. Yeah, you're disrupting class. Tell those people that are there to go bye-bye. Tell your friends to leave. Yeah, you're getting in trouble. Yeah, you need to find a quiet spot. Okay, all right. All right, so again, math people, how can I simplify this expression? I can factor out that Q, right? So another way to look at it is that the difference between the price and average total cost times the quantity gives you your profit. It's just another way to rewrite the profit equation. So we kind of got these three ways to looking at it. $1 minus 20 cents gives you 80 cents per glass, times the 100 glasses gives me $80 worth of profit. Right? All right, so that is what we're attempting to maximize. And this week, we're going to focus in on the cost part. So to kind of tee things up for you, we'll talk a little bit about the whole equation today first, but this is chapter 11. So chapter 11 is going to be really exclusively on the cost in detail. And then total revenue part, that'll come into play more in the following week, chapter 12. And it's really ultimately going to be chapter 12 through 14. We'll spend the next 3 chapters kind of looking at all of it. So this is a big deal today, kind of setting the stage for all of the material that's forthcoming. So this week we're on chapter 10 and 11 is what we'll be covering, kind of costs and details. All right. So let's see. Let's just do an example right away. So suppose we've got an English professor. Suppose an English professor decides to open a restaurant and quit teaching, quit profiting. He currently makes $60,000 a year at the university. So, what's the name of the restaurant? What's his restaurant name? What did I hear?
Bad decisions.
Bad Decisions. That's not an interesting one. Colin, what'd you say?
Black sheep.
Black Sheep. I heard here. Somebody else?
Yeah.
I thought I heard somebody mumble something over here.
John's.
John's what? Jong's Long Dongs. Okay, so that might be. All right. So John's Long Dongs. What are dongs? Hot dog. Dogs, not dogs. Oh, these are dong dogs. Okay. Got it. So JLD for short, right? And whether it's a dong or a dog, you guys can edit your papers accordingly. All right. So John, the English professor's got those details, and so now he's collected some money. So for some different costs of his building, he's got rent for the building of $50,000 a year. He's got some grills, coolers, other equipment, etc. That he's got some sort of lease deal going for, expecting a cost of $200,000 a year. And then, of course, he's got some labor, cooks and wait staff, dishwashers, etc. Other sorts of labor that's going to run $110,000 a year. And then finally, the ex-prof will be the manager. The ex-prof will be the manager so that he does not have to pay, the market rate of $35,000 per year for a manager. So if total revenue is equal to 400,000 per year, what are profits? What are profits? So I'm going to give you a few minutes to start working out this problem on your own. You can kind of chat with your neighbor if you want. Any questions on the setup? Okay, what are profits? What is the profit for our English professor? Good luck. Did everybody get an attendance sheet, by the way? Why don't you guys just come up after class? So, profit. So I'll give you a hint. You can start with the equation. Profits equal total revenue minus total cost. That's a great first start to your problem. That's really the way to tackle a test problem. I'll probably give you partial credit if you can just simply regurgitate total revenue minus total cost. Profit equals total revenue minus total cost. There's some partial credit just to have that memorized. As soon as you have an answer, I want to hear some of them. 40,000? I hear a 40.
75.
I hear a 75. Anybody else? Ooh, I love all the deliberation going on here. So what are you guys coming up with? I heard a 40. Does anybody second to 40? All right, I see lots of seconds. 1, 2, 3, 4, 5, 6, 7. All right, 75. Do I hear a second on 75? You only got a second, so we got 2 75s. Any other answers that you want to throw out there? All right, so if we're following the total revenue minus total cost, we've got 400,000. And then you people who were up on the 40s, what'd you do over here? Add them all up, good. And if this were projecting all of our costs, we got 50, 250, 350, 360, right? So we got our $360,000. So 400 minus 360. I'm putting a K here for the zeros. Looks like we got 40,000. Okay, so what's up with this 75 business?
I figured since you don't pay the manager, that's what you're working, so he as the owner of the restaurant, he would make 40K and his wages would be 35.
Okay, so you want to add in,
Yeah.
so he's really making 75 by working his tail off.
Yeah, working there.
Okay. What? Yeah, should it be subtracted rather than added? You got a 5,000, which is what that would be, right? So if you took that, you might be looking at like 5,000 if you had to pay yourself. But at the end of the day, let's just face it. The English professor looks at what does he have for spendable money to run to Walmart and to live his life. How much money does he have? 40, right? So whether we do something fancy here with the 35 or not, if he pays himself 35, then he'd have 35 plus 5 is 40, right? So at the end of the day, the English professor is likely going to calculate profits this way. And in some respects, there's nothing wrong with that. That followed the rule here. So English professor, I guess his name is John. We've named him. John's long dogs. English professor calculates this way. So possibly his, what do you guys think this 35 at the table then? What does the 35 add to the discussion? What's that? I mean, why add it? And by the way, I think there's some reasons to add it potentially, but why? What does the 5 represent? Those of you two had a 5. Why were you more comfortable with a 5?
That's what the business.
Okay, that's what the business might be making, right? So if we think about business profit versus profit as a sole proprietor, then we've kind of done that. And that might be required for IRS purposes potentially, that you have to pay yourself some sort of wage or it better reflects. So, and maybe there's tax benefits, who knows? So the accounting prof, accountant, I guess I'm trying to say it as a person, accountant profit might be total revenue we all agree on, those expenses we all agree on, but she says we should have this so that we have the business profit, right? This is the business profit. Maybe this is for tax purposes. So the English professor says, well, I don't care, you can do your hocus pocus, I just know that I've got 40,000 to spend, right? Whether you carve it up as 5 for the business and 35 for me, again, the last time I checked, 35 plus 5 is 40. So it doesn't really matter to him, but maybe from an accounting standpoint, that's more appropriate. Okay. Now, nobody came up with the principles of economics, young, budding brains thinking about how an economist might calculate profits, the economic way of thinking. Is 35 the right thing to calculate? If we think about opportunity costs, yeah.
Well, this is original money that he had going into it all.
No, we don't have that factored in. It's just what his paycheck was at OU. So how should that be in there or not? What's that? Technically, he's losing money if we look at his opportunity costs, right? He's giving up $60,000 to do this. So if he wasn't so sick and tired of those doggone kids that are making up the difference here, assuming that he's just looking for the numbers, the appropriate number to put in from an economic standpoint would be his opportunity cost, his highest valued alternative that he foregone, right? So he's giving up 60, so 35 is really not enough. So the economic profit considers all opportunity cost. So economic profit is what we do in this class. And that is 400K minus the 360 minus the 60 gives us minus 20,000. Minus 20,000. Now, once again, the English professor might be looking at both the accountant and the economist saying, I don't care, I know I've got 40 to spend, right? But is the company really profitable? Is this really what he should be doing? And so what we want in economics class is we want our profits to be sending a signal, out to the market and out to the people involved in the market, here specifically John. And so instead of flashing, you made 40,000, you made 5 plus 35. The signal coming from the economic standpoint is minus 20, minus 20, minus 20. And what is that signaling to the John, our long dong operator?
This would be a bad choice.
It'd be a bad choice, right? Pursue your other alternative. Pursue your other. And so I like to think of it when this is negative in econ class, it's saying you suck, you suck, you suck, you suck. Go do something else. What should I do? That. It's there, it's available, because we used a real number. We used the highest valued alternative, a viable option for the English professor. And so we want profits to act like a signal. All right, so that's our you suck signal here. So profits now, negative 20 reflects opportunity cost, which is again one of our top 3 principles in economics. Negative 20 reflects our opportunity cost. Now, what if, example number 2, total revenue climbs to 420. So example number 2, suppose total revenue equals 420. What are economic profits now? 0. So we've got the 420 now here for total revenue, minus our 360 of explicit costs, minus our 60K of implicit costs. Gives us a big fat 0. So this is another term. These things are what kind of we all could agree on because there was probably a receipt of purchase and it was just had a price tag associated with it. So these are known as explicit costs. Usually these are accounting costs, is another way to think about it. The costs that our accountant would have tabulated. And the 60K is our implicit cost. Implicit costs, which values our other opportunities that we missed out on. Now, in normal, outside of econ class, companies making 0 profit, do they jump for joy? Are they happy about that? No. 0 profits are bad, right? But in econ class, is 0 profit bad? No, right? Because it's saying you're covering your other opportunities. You've covered your other opportunities. So 0 profits are okay. They're not great. We'd always like them to be bigger because we're looking to maximize profits, but they're at least okay. All right, so 0 profits, note, 0 profit is okay in econ class because total costs include opportunity costs. And in general, that implies you can't do better elsewhere. you can't do better elsewhere because those opportunity costs are specific to you. All right. Example number 3, unless there's any questions on number 2 so far. Example number 3. Suppose we've hung in there and we're making $460,000. So suppose total revenue equals $460,000. How much is profit now? 40,000, right? So again, just to make sure we're being clear here, 460 minus our 360 minus our 60,000 implicit costs gives me 40,000 to the good. So now I have positive economic profit. All right, so what kind of signal's going out now? Good job. What else? You don't suck. I like that. What else?
Quit teaching.
Quit teaching. Yep, you made a good decision. Confirmed our decision. But what else does it send out to the market? Who else is seeing this signal? Other what? Other English professors, potentially. Who else? Other investors, other competitors, other restaurant people. And so when they start to hear word that some English professor who's never had a business class in his life is freaking rolling in the dough with this restaurant in town, what might they get the idea of doing? Doing a restaurant business, right? If that English professor can do it, I got my MBA and I like food and I think I can do a better job than the English professor. So now the signal going out is enter, enter, enter. This is a profitable business. Come to me like flies to the light, big bright light. The flies are drawn to the area or the market that's being served by this one individual entrepreneur, right? So we want to treat profits like a signal. If there's losses, it was flashing the you suck, but also exit, leave, stop doing what you're doing, right? Do something else, your higher valued alternative. So we've got an important signal that's going out to the marketplace when we start to think of things in the context of economic profits. All right, questions or comments there? All right, so let me summarize some of that for your notes here. So profits as a signal, key point. Profits as a signal. Profits as a signal. Number 1, if economic profits are negative, less than 0. If economic profits are less than 0, then we get the exit, or more fun, you suck. The you suck signal is going out. If economic profits are equal to 0, it's okay. It's okay. We're always trying to make more money, but are we going to be attracting new competitors if they're just earning kind of an average rate of return, right? There's nothing special going on. So it's not going to attract new people or cause people to leave. They're getting a fair return on their money. So you could think about economics being a quote-unquote fair return for the resources being used. And then number 3, if economic profits are positive, greater than 0, that's going to be signaling enter. So you're going to likely be facing some competition. Profits are above and beyond the opportunity cost of the resources being used in that industry. There's a lot of gravy being made. All right, now, we saw this a little bit in Chapter 3, that if there is entry into a market, what was our predictions we did from Chapter 3? Entry into a market. What happens to price and quantity, but price is the one to think about. Entry into a market. Prices drop, right? And so if we kind of think back to our gut feeling here, if there's all of a sudden a lot more pizza joints in town, then we should expect that the prices of pizza might be falling, right? Because people are going to be running sales to try to get business their direction. And so the falling price is going to happen. If price falls, what do you predict is going to happen to profit? If price falls, it's going to fall too, right? So we go back to here, to this equation, and remember that total revenue is price times quantity minus total cost. If prices start to drop, total revenue starts to drop, and those profits are going to be squeezed away, right? Okay. Any other questions there? Let's try another one. So the restaurant needs a grill. Suppose the restaurant needs a grill. The grill has a price of $10,000. So a $10,000 grill, the business is booming. We need to increase capacity so we can flip more burgers. So example number, what are we on here? 4, I guess, but this is really changing basis. We need a new grill, and its price is $10,000. And the question at hand is, should we pay cash or get a loan? So if we get a loan, the interest rate is going to be 10%. And the leasing company's got a great deal, 10%, 1 year. How much interest is it going to cost us? We do the loan deal, $1,000, right? 10% of $10,000 is $1,000, right? So ultimately, that loan is going to run us $1,000. So let's assume that we have the cash available. So we have, maybe we have, $30,000 in cash reserves. So with the cash option, we have cash. So some of you might be thinking, well, if you got cash, just pay cash. Why would you even entertain the loan? But what else can cash be used for when you're running a business? Inventory, investments, and other things. What'd you say? Bargain. Yeah, you might be able to bargain for it. Yeah, from personal finance class, so that might be a bonus. But you have other things that are going on with your business. You usually have to have some cash on hand, right? So it might not be immediately obvious. It's definitely a decision here. Should I go with the loan or should I not? All right, so how do we calculate this? Which one should we do? So which one should we do? And more importantly, why? So we've got cash of $10,000 today, and we've got a loan option, which is going to be essentially 11,000 tomorrow, right? So 10,000 plus the $1,000 interest tomorrow, for 1 year from now, I guess, for 1 year. So we got 11,000 versus 10,000. Which one's better? Okay, what situation? That's what I want to hear.
How much cash do you have?
Okay, so we have enough cash. We could do it, and so we're not. I don't want the decision to be completely like cash constrained. So maybe we've got 30,000 account. You know, we're not going to die. We can rebuild our cash reserves. We don't have any certain unexpected things going on in the future. Drew? Ah, good. All right. So what's not fair is to say this one's 11,000 versus 10,000, right? And that's what we kind of want to do, is to say, well, it's cheaper if we can pay cash, so just do it. But that's not really nailing it down tight enough. And so, Drew, what were you saying? I think you're on to the right thing. I didn't.
Then use the cash today to generate more than 11,000.
Okay, good. So if we were to kind of rewrite this, it's really not fair to compare today versus 1 year from now. Because really what we're doing is we're saying it's $10,000 today or $11,000 1 year now. Which one should I pick? Well, that's not really fair to think about it that way. So what Drew's suggesting is, what else could we be doing with the 10,000 over the next year? And so if we can take that 10,000 and earn 15% on it, should I take the loan or should I pay cash? Take the loan, right? So if one possibility is at 15%, if we can get 15% on our money, then after 1 year, the real cost of using cash is I'm giving up that extra $1,500. And so the least costly one is to do the loan, right? This 10,000 1 year from now will be worth 11,500 if we put it into other things. In a business setting, that could be expanding our business a little bit more. We're kind of doing that a little bit with the grill purchase, but maybe there's other things that we could be new advertising. Oh, what's the social media thing? I don't know, maybe we should pay per click or something, right? So there's lots of different ways. If we can generate more business into our business, it's likely we might be able to do greater than 10% on the interest, potentially. But you need to look at that closely. Because if instead we can only do 7% on our money, then the real cost of cash today is $10,700. And now it's cheaper to pay cash than to do the loan. The grill is really costing me $10,700. Here it's costing me $11,000. Let's take the cheaper version. But what's driving that result in both cases is opportunity cost. So the answer depends on your opportunity cost. And that answer is going to be different for each person or each company. Some people might not be able to get anything on their cash. All right, questions there? So from here on out in this class, other than if a question like this chapter is asking you to distinguish some of these finer points, whenever I say profit, we're talking about economic profit. So I'm not going to say economic profit every time. I might say it once in a while, but if I say the word profit, you can assume we're talking about economic profit since we're in economics class. And what that means is that the implicit costs are included in the total cost. And when we calculated the cost of the grill, we did include the opportunity cost factor in it. All of those implicit costs were included. Okay? Questions there? All right, so So let's kind of look at other ways to characterize costs. Let's see, I think I'll erase everything. I want you to imagine a grocery store. And think about the types of costs that go into running a grocery store. I'm picking a grocery store because we've all been in grocery stores, likely. It'd be very unusual if somebody hasn't been in a grocery store. I want you to imagine yourself parking your car, going into Price Chopper, and looking around. Start brainstorming a list of the different types of costs associated with a grocery store. All the costs of doing business. Okay, I'm going to go ahead and capture them as you guys, hopefully you got some off the top of your head. So, grocery store costs. Go. Utilities.
Players.
Okay, let me get some fresh ones. If you've said one, then just kind of keep quiet for a while until things take down. I want a list of about 30 things. So go. Labor, like what? Give me specifics. No, what kind of labor? Like the checkout person, the manager? Who is it?
Deli.
All right, so the deli labor. Got it.
Produce.
Produce. Meat. Advertising. Good. The shelves, the carts. Shelves, carts. Uniforms. Pharmacy. And what about the pharmacy? Because that's like almost a whole store within a store.
Pharmacist.
What's the pharmacist? Okay. Pharmacist. Okay? Security. Security, good. Yeah, you should be writing these down as you go too. Maintenance, good. Come on, I want to get to 30. We're only at 12. Be in the store. Look around you. What's in there? Lights. Cashiers.
Shots.
Trucks. Shampoo.
The building.
The what?
The building. Parking lot.
Parking lot. What else?
Building maintenance.
The building. Water fountains. Fancy. Right. Water fountains. Coolers. Good. Janitors. But that's okay. We're brainstorming. So other than clarifying, I'm trying not to shut any of your answers down. Like there really isn't any wrong answer unless we kind of clarify it to get it on the list. So janitor, and those are two different things because you got the cleaning supplies, right? Milk. Restrooms. Toilet paper. Is that toilet paper in the restroom or on the shelves? Both. If it's both, we need to put both. Toilet paper in bathroom and toilet paper on shelf. Okay? Liquor. Tobacco. Get all the syntaxes out here in one time, okay? Now let's step back. Let's try to, we've got enough products up there. Let's go outside the products. Auto service, okay? Not a full grocery store. Just the grocery store.
The handicap price.
What else? We had advertising. Anything else like this? You had security. That was a good one. Signs. That's a good one. All right. Signs. Accountants. Yes, definitely. Managers. Good. How about an attorney? Legal?
Yeah, so.
All right, there we go. So legal fees. All right, so there's our list of 30. So the reason I wanted to get some reality on this was to now think about an important concept associated with running your business. And think about what makes profit for us. How does this company really make profit? At the bottom line, just kind of get into the cut piece. Kind of like my son selling a lemonade stand. How does he make money? He gets lemonade out to people, right? What does this company do? Get the products to the people, right? So we've got the number of beeps going on, right? Beep, beep, beep. You're at the checkout line, beep. The more beeps, the more things being sold, right? So out of that, with that in mind, what types of costs change with the number of beeps? In other words, you're incurring cost as you're selling more stuff, our kind of primary way that we make money. Which things have a cost associated with the higher volume of business, if you will, the more queue, the number, the quantity of stuff going out?
3 and 4.
3 and 4, so produce, right? So if I beep the produce, then I incurred a cost for that, right? And we're not talking about timing and cash flows, but there's a cost that varies with that. 15, shampoo, good. So all of our products are going to be picked off the list now, right? So tobacco, I lost track of where they all are, maybe some milk. Toilet paper, which one? On the shelf. Now, what about in the bathroom? More people using it, right? So there's an argument there that that is a cost that it's going to be. The more volume, the more beeps going on, the more poops going on. So beeps and poops kind of go together to some degree. So this one might have a variable factor to it. Now, what about the restrooms, though? The toilet paper's in the restroom. What about the toilet paper holder? The stall, the toilet itself, all of that stuff doesn't change. What about the water on the flush? Right? So the water on the flush is probably variable. More beeps, more poops, more flushes, right? All right, what else? Cashiers. Let's see, where's that one? 13. 13. Well, what I thought was meant by trucks, and tell me if I'm wrong, like delivery trucks or whatever. So on a given day, you know, would that affect if beeps going on? Would you all of a sudden have more truck expense? Of maybe gas or something though, right? So the actual truck, depending on how we do it, if the truck was a $15,000 truck, then it wouldn't number of beeps, right? The truck cost. But if it was some sort of delivery thing where you're spending gas, then you would. Go ahead. What's that?
Increase the number of trucks. Be able to deliver more.
Yeah, but on a given day though, on a given day, do we have more trucks? I just want to make sure I'm understanding you guys. On a given day, one day, if there's more beeps, if we have 500 beeps or 5,000 beeps, do we incur a cost for the trucks?
On that day?
On that day, probably not, unless I'm misunderstanding what you guys are talking about. What are you talking about? I might be misunderstanding
I
you.
was at the vet, and so when we sell out of something, we have to have another, like we don't have one truck coming in, then we have 2 or 3.
But on a given day, we're probably screwed, right? We're just out of it, out of stock of that item. We probably won't be able to do it. For a week or something, then we'd probably be able to adjust. Okay? Anything here? Lights, parking, building, water fountains,
Carts.
manager. Yeah, what about the manager?
So they're over there by 29.
29, okay, yeah. What about the manager? On a given day, Who do we cut if business is slow? If beeps are down, who gets cut? Cashiers, right? So if anything, the cashiers are going to be the ones getting cut, but the manager, somebody's got to be there if we've obligated ourselves to be open from 10 a.m. to 10 p.m. or whatever. Somebody's got to close it down. All right, so let's see, deli labor. That could vary, but if we, again, have obligated to have somebody staffing the deli counter during our normal business hours, then we're probably stuck with that person there. Shelves, carts. All right, so the important thing that we're identifying that is important for all businesses, no matter what you're selling, is to look at those costs that vary with your output and those costs that do not. So the new distinction that we're making, which is, by the way, getting us into chapter 11 already, total cost is equal to total variable cost. Let me write this out this way first before my acronyms. We already did TC. Total cost is equal to total variable cost plus total fixed cost. In other words, in theory, we can go through the whole list and put all costs into one of these two categories. Total variable cost plus total fixed cost. So when analyzing things, this is important because if we choose to not be open today, we're closed on Sundays due to religion or due to otherwise, just because business sucks on Sundays. Unlikely for a grocery store. What kind of costs do we still have? We still have our fixed costs. We still have our advertising bill that we have wherever advertising is over here. 5, right? Nothing's changed. Whether we're open or not that day, we still have that cost. We still have the cost of the shelves, the carts, and all of the infrastructure that's there. That building is just sitting idle when it's empty. We saved on not having the cashier come in, which I don't remember where here it is, 13, right? We saved on that labor, but if the manager is paid a fixed salary of $40,000 a year, did we save anything by not being open on Sunday? No, right? See where we're going with this? So that's important for decisions with the business, is that total fixed costs do not vary with quantity, and total variable costs do. So it's pretty simple definition here. Total variable costs vary with the quantity produced / sold. Total fixed costs do not vary with quantity. So the important kind of key note here that you will see in homework problems is that if quantity equals 0, if we choose to shut down, now economists, I'll get into this a little bit later, we're not going out of business, we're just shutting down the operations for the day or for the night or whatever. When we shut down, if Q equals 0, then total cost equals total fixed cost. Our equation has variable costs disappear from it. And again, sometimes this isn't easy to figure out. Like electric. If we look at the utility of our electric bill, does it vary when we have more beeps? So we're doing a lot of business. Is there more electric bill? I see some head shaking. Why? The beeps cost money? Is it a penny per beep or something? Or okay, the cost to run the computer system, but on a given day of business, is it drawing any more any more electricity for that computer to do 5,000 beeps versus 500 beeps? Like each beep is like a little, it draws more energy. I'm not an engineer, so that might be somewhat true, but it sounds unlikely.
It depends on how many registers you have open.
Okay, yeah, so the register thing could be a part of the variability. Good. Yeah, and so but shut down. Does electricity bill go to 0 when we shut down for the day? What else is going on in there?
Air conditioning.
Air conditioning, the coolers. Yeah, the coolers are the big one. We can't let all of our goods spoil. So we still have electric, and probably for the most part, I would guess that the electric bill is pretty similar during operations versus shutdown, although that could vary depending on what's going on. You probably still have lights on for security purposes, right? We don't leave it completely black for security. We probably have some lights on. The coolers are running, but not everything. So my point with that is that electricity very well might be part variable and part fixed. But it's possible to estimate what part's fixed, what part's variable, right? Pretty easy, actually. Shut down, if you're closed on Sundays, look at what your electric bill is on Sunday or your meter usage versus the day when you're open. And you'll quickly find what part of your electric bill is variable and what part is fixed, right? So it's possible to look at that. All right. Any questions so far? All right, so let's see here. Let's do this. So key formula: total cost equals total variable cost plus total fixed cost. I introduced you early to the idea of thinking about average total costs. Average total cost. So how much was it per glass for my son's lemonade, Sam, with the examples? Not $1. The dollar was the price. It was 20 cents, remember? So 20 cents was the average total cost. I just kind of threw some numbers together and said, we've got $20 worth of cost divided by 100 units, right? Yes? Yes. Yep. Average total cost is total cost divided by quantity. So what I want to do is do that here with our equation goggles on. If I divide this by quantity, I get what we did earlier, right? Carter's total cost was $20 worth of cost for the lemonade. He sold 100 units, right? Now that we've got an equation here, what I to the left-hand side of the equation, what do I got to do over here? Same thing. So we get this nice little relationship here. And average total cost is equal to the sum of average variable cost and average fixed cost. Because all we did is separate them out. So you should memorize, I suggest you memorize that equation. It'll help you with your homework and tests and other things as we move forward. What's nice is that it's got like 6 different equations wrapped up into one expression. So we got the one we started off with, total cost equals total variable cost plus total fixed, right? We've also got an equation, average total cost equals total cost divided by quantity. Average variable cost equals that. Average fixed cost equals that. The sum of the averages equals the total. So it's kind of a bunch of formulas wrapped up into one, because you'll get a homework question or a test question that'll say, suppose total variable cost is $100,000, and there's 50,000 units sold. What is average variable cost? So if you have this down, you'll have those quick little formulas in mind all in one spot, rather than trying to memorize 5 different formulas. I think you can get it all in this expression here. All right, so I think it's time for some graphing nuggets. And we're going to start with average fixed cost and total fixed cost. So if our total fixed cost curve, by the way, we're going to start putting dollars over here now instead of price, because price is $1, and we're going to combine the two together. Right? So when we did demand and supply, we put price here because we were talking about the demand curve or the supply curve. But now we're going to talk about other things, and so it's a little more general. And if we were to graph total fixed cost equal to $50, suppose total fixed cost equal $50, what would that graph look like in quantity and dollar space? What does that thing look like? Total fixed cost equals $50. Horizontal line, right? So why do you say that? Cost doesn't change at, be a little more specific, cost doesn't change at any quantity, right? At any quantity. So let's just kind of map that out. So at 0, we still have $50 worth of fixed costs. At 100 units, $50. At 200 units, $50. $50, $50. The total fixed cost curve is not a curve at all. That's kind of a lousy horizontal line, but that is just a straight line saying that at any quantities, total fixed cost is $50. All right, so what is the average fixed cost curve going to look like? Average fixed cost. Here's the formula right here. What does the average fixed cost curve look like? Depends on the quantity, good, but in general, what's its shape? Is it upward sloping, downward sloping, increasing, decreasing? What's that, downward sloping? Right? So if we look at the average fixed cost of producing 1 unit, way over here, what's the average fixed cost of if I only produce 1 unit? 50. Total fixed cost of 50 divided by 1 tells me that the average fixed cost is 50. So it looks to me like it's the same. But pretty quickly, what happens if I produce 2 units? What's my average fixed cost? 25. We cut this sucker in half like immediately. So if we go to 2 units, now we've dropped down to here 3 units. Math is getting a little tough on us here. Maybe I should have used 100. How much? 12.5? 16.66, right? So somewhere in the 16, just 50 divided by 3, whatever that turns out to be, right? So 16 something. If I've got 4 units, this is or let's say 5 units, that's even easier. Average fixed cost if I produce 5 units, $10, right? So at here, I'm down to $5 at 10 units, 50 divided by 10. And so what we see is a pretty dramatic curve downward. And then if I go out to 50 units, average fixed cost of producing 50 units, $1, right? 50 divided by 50 is 1. And so we're to get really close to the horizontal axis, but are we ever going to get there? No. So the average fixed cost gets really close to 0 the more I make. which is another important principle to think about. Why we have companies, especially those with large fixed costs, wanting to do high volume. The more they sell, the more they get rid of some of those big fixed costs. All right, so that's our average fixed cost line and our total fixed costs. Any questions there? All right, what about the other ones? The other ones is where it gets interesting. So, I need to get a blue marker. All right. So graphing average total cost and average variable cost. Your textbook has some nice pictures of the total cost and all the connections. So I'll just point you there for some of that stuff. So I'm just going to show you what they look like, and then we're going to kind of backwards explain them because they're a little more challenging. So I want you to draw a bowl like this, and that is going to be your average total cost. I'm going to let you catch up. The next thing you to do is to put a big fat dot at the minimum of your bowl. Just put a big fat dot there. That's kind of obvious. Turns out to be an important point. I mean, for one thing, you can see that the average total costs are minimized at that point, right? So at this quantity, whatever that quantity is, average total costs are minimum. So that's kind of interesting. We'll come back to that later. The average variable cost line does this. Now watch me do this. Don't start drawing right away because this is more tricky than it looks. So I want you to come down, and then as you're coming up, start to narrow the vertical height of the average variable cost coming to the average total cost curve. And I didn't mention it, but usually you just naturally have the minimum point is somewhere to the left. It needs, if you didn't do it, then you need to redraw it. But usually you kind of do that almost naturally anyway. Okay, so once again, this is the minimum points of average variable cost and average total. So why is the vertical height shrinking as we move up? I've given you enough information for you to deduce that. Yes?
Your average fixed cost.
Okay, average fixed cost is falling. That's right. So if we look to this part of the equation, these two added together equals this. So if I pick off any old quantity here, if you guys want to pick off a quantity and call it just Q1, at this quantity, and let's just say it's 1,000 units, just to give kind of our brains a little relief from this abstract stuff. So at 1,000 units, if my company's making 1,000 units, to tell what the average variable cost of producing 1,000 units is, I go up to the average variable cost curve, hang a left, and read off this dollar value here, average variable cost. And so if this number over here was $10, then my average variable cost at that point is 1,000. What's my total variable cost if that was the case? Using my numbers, so 1,000 units. And I learned that the average variable cost per unit was $10. How much is my total variable cost? 10,000, right? So 10 times 1,000. If you take this formula here, We kind of memorize it a little bit differently, but what this is saying is average variable cost equals total variable cost divided by quantity. And if I take this sucker and put it over here, whoop, total variable cost equals quantity times average variable cost. So it's 10,000 bucks. What about graphically with rectangle garbage? Does that work here? We've outlined this, right? Base times height, kind of back to what we were doing with consumer producer surplus and taxes. So this rectangle now represents the total variable cost. So the total variable cost, base times height for a rectangle, 1,000 units times $10 would give you that area, which would be the total variable cost. So we got a lot going on with the graph that we can see that we don't always shade in. So kind of start to train your brain to think about those things on the axes and whatnot. So again, at $1,000, the average, 1,000 units, sorry, the 1,000 units, the average total cost, we go up to the average total cost curve because it conveys that information, hang a left, and the average total cost is equal to whatever this number is. Let's say it's $12. If that's the case, what is the total cost of production if my average total cost is 12? 12,000. So back to this top line equation, I've got $12,000 worth. Now you can see where the homework test problems are going to go, right? I can do that, and we're going to say, what is the total fixed cost, right? So the total fixed cost is involved in here that we can do a couple different ways. So the average total cost is 12. The average variable cost is 10, meaning the average fixed is 2, right? So we got 2, which is actually this vertical height here, the difference between the two. And I lost, well, let's see if my blue can come out here. This vertical height right here is average fixed cost. So average variable plus average fixed equals average total. And that's how graphically we tackle this equation. But be able to go back and forth in some cases. So questions so far? Now the total fixed cost is this rectangle. So if we deal in rectangles, we're dealing with the total, the top line. So watch this, we've got the green rectangle plus the blue rectangle, which I didn't really cover full blue, equals the red rectangle. So all of that stuff kind of works the same way it's showing you in the equation. This is with our graphing goggles on. All right, questions? Don't be bashful. All right, so the most important curve we haven't talked about yet, but we did introduce it in chapter 2. What cost curve could that be? Begins with an M. Marginal, good. All right, we're starting to get that. So we don't have anything here with marginal cost. All right, so that is the one that's most important for economics class. So we're missing the most important cost curve. And that one is marginal cost, which we've defined before. When you hear the word marginal, you're thinking, I like the per unit stuff, but what's the word we can kind of use interchangeably with marginal? Begins with an A.
Average.
No, that's exactly what we're contrasting it with. The marginal unit. Available, that's a good guess. Additional, yes, additional, right? So marginal additional, what's the extra unit, the additional cost? So marginal cost is the cost associated with an additional unit of production. So marginal cost is the cost associated with an additional unit of production in this case. So underline the additional word again. Flipping on our equation goggles, marginal cost is equal to the change in total cost divided by the change in quantity. Marginal cost is equal to the change in total cost divided by the change in quantity. Now, if you're not careful, this formula looks suspiciously like what? Average total cost, check it out. Average total cost is this. This one looks like this. What's the difference? The change, the little deltas in there, the little triangles, so that we're adding on something else. So don't overlook that part. That marginal cost is the change in total cost. Now, I'm going to push you a little on the math spectrum here. Since we've got the little change thing, we can kind of do what we did last time by thinking, oh, well, how does this change? Well, let's put that little change factor through the equation. By adding that. All I'm doing is pushing the little triangle through this equation. Everybody got that? You guys, can you see the board from there, Colin? You can see this last stuff? Okay, well, there's open seats over here, so I try not to spend too much time on that side, but and I'll speak it as I write it, but if you guys want to move, you can. And don't even feel bashful to stand up and look if you want. This equation can be simplified. This equation, I should say, can be simplified. Does anybody see it? What about the quantity? We can factor it out. We can factor it out, but that just gives us still kind of the two things in there, right? With the two expressions, if we did 1 over the change in Q. That's not. There's an easier. There's even better simplification to it. This one's probably worth an extra credit point if somebody can tell me how that. What's that? Factor out the delta? No, it doesn't deal with factoring.
Times the delta Q on the other side of MC.
Nope.
What are you looking for? MC, right?
If you multiply through the delta Q, that's not going to get us what we need either, because then you'd be stuck with it over on this side. We're looking to simplify that expression. Let me give you a little nudge. You got something? Let me give you a little nudge. Yeah. ATC, no. Switching average, nope. That sounds like you guys are going kind of similar direction. Let me walk you through what's in the equation verbally, and I'm hoping something will click for some of you. The marginal cost is the change in total variable cost from changing quantity and the change in total fixed cost from changing quantity.
You just say equals.
Hey, how are you compacting it? I think I'd be on the right track. No, but it's simpler than that. Let me go through the expression again. Hang on my words and think about what we've done already today, because what I've given you is enough to solve this one. Marginal cost is the change in total variable cost from a change in quantity plus the change in total fixed cost
Average total cost.
from a change in quantity.
Change in average total cost.
Nope. I think you're dancing on the right thing. The change in total fixed costs. The change in total fixed cost. When I have more beeps, it's the change in my total fixed cost. What's that? Total fixed cost doesn't change with more beeps. What's it equal to then from an equation standpoint? Zippo. 0 divided by some number is Zippo. Gonzo. It doesn't exist. Costs don't change. So the reason I wanted to bring you through that is to hopefully link it back to the grocery store and this very important concept of marginal cost, that the only cost you really are looking at are variable costs. So from a homework standpoint, you need to know both of these. In other words, total costs only change due to variable costs by definition from a change in quantity, right? So you can use either one of those formulas to calculate marginal cost. All right, so graphing goggles. This one I'm going to give to you, and then we're going to backwards induction feed it to our brains here. So these two big fat dots that represent the minimum, there's a J-shaped marginal cost curve that cuts through those 2 points. So go ahead and draw that on your graph. Make sure you give a little bit of a J here, so it kind of drops down, and then it comes up through the minimum point. All right, so if this is our restaurant and we're talking about hamburgers or something, you know, if this is hamburgers, this seems kind of weird at first. This says that the cost of the 1,000th burger, because we have our suffix goggles on, when I see the marginal curve, all of a sudden, magically, mystically, the 1,000 units becomes a 1,000th unit tied to the marginal cost curve. The cost of the 1,000th hamburger is way up here, but on average, it only cost me $12. But yet, this unit over here, the cost, let me pick on this unit. The cost of this unit was way down here at $2, but the average cost of this many units was way up here. So that's kind of weird. Are these units different from each other? I mean, different in quality, like this one's higher quality, of course, and this one's lower? No, these are all the exact same units, right? So we get this thing going on, which is a bit of a mystery we need to think about. But let me start you off with your grade point average. So suppose you've been at OU for 2 years, and you've currently got a 3.0 going. But as you enter your junior year, you turn 21, and before you know it, you're drinking a little more heavily than you did before when you were illegally drinking, because now you can have the added fun of going to the bar too. And so the fall semester of your junior year, you get a 2.5. Is your overall GPA going to fall to a 2.5? No, right? Because you've got 2 years worth of grades before it. So your overall GPA isn't going to fall. Is your overall GPA going to fall? Yes. If you got a 2.5 for the fall semester and you had an overall 3.0, it's going to fall. It's not going to fall to a 2.5, but it's going to fall. Let's say it falls to a 2.7. Parents are a little upset with you. You're a little upset with yourself. You start to kind of straighten your act. I got to do a little bit better. So indeed, you do better. In spring semester, you get a 2.7. With a 2.7, which is better than your 2.5, is your overall GPA going to go up? No, because your overall was at 2.7. You got a 2.7, so you're adding on grades that were the same as your overall average, right? So now, senior year, you're like, crap, I'm going to be on the job market pretty soon. I got to get my crap together. Fall semester, senior year, 4.0, bullets across the board. Does your overall GPA rise to a 4.0? No. But that's a lot of A's being added to the average. It's going to go up, right? So maybe you get up to a 3.1 or something. I don't know. Just making up numbers. But that's the relationship between marginal grades and your average grade. And that's what's going on with hamburgers here, or whatever we're selling. The same type of thing. We've got the marginal hamburger costing more for some reason than the previous ones. And so marginal versus average, our decisions end up being more important at the margin. The marginal grade of a 2.5 was kind of a signal. What signal do you think that was sending out if you were a 3.0 student before? You suck. Get your crap together. Do better, right? So the marginal signal was more important. So let's just say GPA example. So you've got 2 years, you have an overall GPA of 3.0 GPA. And then fall of, like 2017, you get a 2.5. Your overall is going to change, but not change dramatically. So your overall falls to, let's say, 2.7 using the numbers that we did. And then finally, you get your, oh, not finally, I guess we're going to do a couple rounds of this. Spring 18, you get a 2.7. We're starting to see progress. My marginal grade went up, but it was the same as my overall, so my overall stays at 2.7. And then finally, fall of 18, we get a 4.0. The 4.0 does not raise 4.0, but maybe we get up to a 3.1 overall GPA. So these grades, your semester grades, are your marginal ones. And this is your overall. All right, we will pick up there on Wednesday.